G'day traders. You won't believe the absolute carnage that just ripped through the oil markets, sending the global economy into a spin. We've seen a crash so massive, it's wiped out billions in minutes, and the gold price is acting like a total loose cannon. Today, we're breaking down the oil price wipeout, the gold rebound, and why the AI tech giants are hungry for our metals. We're diving deep into the massive $60 billion chip deal, and why copper is becoming the new digital gold. Plus, we'll check if the Aussie dollar is standing its ground or getting pummeled by the greenback's sudden short squeeze. Just a quick heads up, legends, I'm a trader, not a licensed advisor, so do your own research before dropping any cash. So here's the big question for the pouch. Is this oil crash a gift for gold, or is the dollar about to crush us all? Toss us a comment with your thoughts, smash that like button, and subscribe to join the legendary Gold Jumper crew. Righto, let's talk about the black gold, because Wednesday, April 8th, was an absolute shocker for the oil bulls. West Texas Intermediate, or WTI, opened up at a whopping $108.74. By the time the dust settled, it had plummeted all the way down to $94.41 per barrel. That is a massive 16.41% drop in a single day, the kind of move that'll make your hair curl. The OVX, which tracks oil volatility, was absolutely screaming at 98.79 on April 7th. It settled back to 83.91 on April 8th, as the market tried to process the ceasefire news. This Hormuz shock happened because reports of a diplomatic breakthrough started flooding the news wires. When the risk of the Strait of Hormuz closing drops, that massive war premium just evaporates like mist in the morning. For us gold traders, cheaper oil usually means less inflation, which gives the central banks an excuse to hold rates high. It's a bit of a double-edged sword, but seeing oil under $100 definitely shifted the vibe on Wall Street. Now, let's look at the yellow metal, because gold has been putting on a real show from April 6th to the 8th. On Monday, April 6th, gold was hanging around $4,676.42. Traders were a bit nervous as the US dollar started flexing its muscles, putting a bit of a dampener on safe haven bids. But by Wednesday, April 8th, gold caught a massive spark and surged up to test $4,835. That's a bloody ripper of a move, nearly 4% up, while the oil market was busy falling off a cliff. It seems the physical demand from central banks is acting like a solid floor, even when the paper markets get shaky. We're seeing nations like Malaysia and South Korea jumping into the gold game after being quiet for ages. Don't sweat the dip, just more room in the pouch, because these big players are buying every single correction. Even with a strong dollar, gold finished April 8th around $4,711. It's a real tug-of-war between geopolitical fear and the high interest rates over in the States. Over on our home turf, the ASX 200 index has been showing some serious grit compared to the SP 500. While Wall Street was closed for the long weekend, our market reopened on April 7th with a massive 2.6% jump. The ASX 200 hit a 4-week high of 8,804 points shortly after the opening bell. That outpaced the US markets easily, mostly thanks to short sellers getting caught with their pants down. Our materials sector, led by the big boys like BHP and Rio Tinto, has been doing some heavy lifting lately. BHP was up nearly 3%, trading around $52.73 on April 7th. It's great to see the local miners getting some love, especially since they've had a rough trot earlier in the year. The ASX is currently sitting about 5.4% below its record high of 9,202 points. If we can reclaim the 200-day moving average at 8,776, we're laughing. But keep an eye on that support level at 8,262 if things turn pear-shaped. Time for a deep dive into the brain of the market, the semiconductor stocks, and the massive AI infrastructure boom. Advanced Micro Devices, or AMD, just signed a legendary deal with Meta Platforms that has the industry buzzing. We're talking about $60 billion worth of AI chips over the next 5 years. That's a serious bit of kit. This deal even gives Meta the option to buy 10% of the whole chip firm, which is absolutely massive news. AMD shares have been on a tear, up 88% over the last year as they chip away at Nvidia's lead. Nvidia is still the king of the mountain though, reporting $68 billion in revenue for their last quarter. Their gross margins are sitting at a healthy 75%, which is just pure gold for their balance sheet. But even the king can stumble. We saw a sell the news event where the sector pulled back despite strong earnings. The Philadelphia Semiconductor Index, or the SOX, has been a total rocket ship, up 43% in 2025. On April 6th, the SOX index was trading at 7,916 points, up about 1%. By April 8th, it surged even higher to $8,510 as the tech bulls stayed hungry. This isn't just a hype bubble, legends. This AI revolution is built on actual hardware and massive computer power. The demand for server memory is so high that Samsung and SK Hynix are planning price hikes of 70%. If you're holding tech, keep an eye on those memory shortages because they're going to persist well past 2026. Data center build-outs are the main engine here, with capital spending surging nearly 60% year over year. Amazon, Google, and Microsoft are all throwing billions at new infrastructure to keep the AI models running hot. And this is exactly where our precious metals come into play, in a way most people don't even realize. Every single megawatt of data center capacity needs between 3 and 5 tons of copper for the electrical systems. In 2026, copper isn't just for pipes anymore, it's a strategic asset for the global AI infrastructure. Estimates show that modern AI facilities might use up to 27 tons of copper per megawatt. That's for the high current busbars, power transformers, and the liquid cooling loops needed for those hot chips. Copper hit $5.74 per pound on April 9th, showing its strength as a growth commodity. Some analysts are calling copper the new gold because the global supply simply cannot keep up with this demand. We're looking at a structural deficit where planned mining projects only meet 70% of what we need by 2035. Silver is also a secret superstar in the AI world because of its incredible electrical and thermal conductivity. It's essential for the circuit boards and connectors that need to stay cool while processing massive datasets. Global IT power capacity has grown over 5,000% since the year 2000, and silver is in all of it. The Silver Institute says we're facing a deficit of 150 million ounces in 2026 alone. That's about 15% of the total global need that we just can't mine fast enough to satisfy. Even gold is being used in high-end connectors and shielding to ensure that AI uptime stays at 99.9%. When you're spending billions on servers, you don't skimp on the metals that keep the electricity flowing smoothly. So, the more the tech giants build, the higher the floor goes for copper, silver, and even our beloved gold. It's a digital age gold rush, and the miners who can pull this stuff out of the ground are sitting on a gold mine. Keep an eye on those junior miners too, because the big players are looking to secure their supply chains. We're seeing a shift where money is rotating from safe haven plays into these growth-oriented tech metals. It's a whole new paradigm for the commodities market, and we're right in the thick of it, legends. Just remember, the demand is structural, not cyclical. This AI genie isn't going back in the bottle anytime soon. Let's talk about the greenback, because the US dollar index, or the DXY, is trying to break its downward trend. Positioning against the dollar has hit a 14-year record for bearishness, which is a bit of a worry. On April 6th, the DXY was sitting around 100.12, holding onto its gains from a strong jobs report. But the de-dollarization trend is gathering steam, especially with this new Petroyuan system popping up. Iran has set up a toll booth in the Strait of Hormuz, where ships have to pay fees in Chinese yuan. This is forcing countries to sell their US treasuries and buy gold so they can trade it for the yuan they need. The New York Fed saw $82 billion worth of treasuries leave their custody in just a few weeks. If the dollar keeps losing its grip as the world's reserve currency, gold is the natural place for that money to hide. Bank of America reckons the DXY could drop another 8% this year, falling toward the 95 level. A weaker dollar is usually a bloody ripper for gold prices, so we'll be watching that 95 mark like a hawk. Now for a quick squiz at the Aussie Dollar, which is currently trading around 70.57 cents. Our currency is caught in a bit of a mess between high domestic inflation and the global risk-off sentiment. The Reserve Bank of Australia kept the cash rate at 4.1% in March, and they're still acting hawkish. Everyone's waiting for the inflation data on April 29th to see if another rate hike is on the cards. If the RBA hikes again while the rest of the world pauses, the Aussie dollar could catch a nice bit of wind. But if the Middle East tensions flare up again, expect people to go running back to the safety of the greenback. It's a tricky spot for the Aussie, but the high prices for our coal and iron ore are providing a bit of a buffer. Just keep an eye on that 70-cent level. If we break below that, it could get a bit grisly for the local buck. Overall, the global macro scene is a proper muddle of energy shocks, debt spirals, and shifting power balances. It's a wild time to be a trader, but that's where the opportunities are if you've got the stomach for it. Let's look at the copper to gold ratio to see what it's telling us about the health of the global economy. Gold is the safe haven, the fear indicator, while copper is Dr. Copper, the indicator of industrial health. When the ratio is rising, it usually means the world is building things and the economy is firing on all cylinders. Right now, copper is holding up incredibly well at $5.74 despite the volatility. This suggests that while there's fear in the air, the actual demand for materials is still going strong. Gold at 4,700 plus and copper at nearly $6 is a rare combo in commodity history. It shows that investors are hedging against inflation while also betting on the big tech and energy transition. If copper starts to outperform gold significantly, it'll be a sign that the global recession fears are fading away. But if gold takes off and leaves copper in the dust, then you know the risk-off move is truly in full swing. It's a fascinating dynamic to watch, especially with the AI boom adding a whole new layer to the equation. Time for the technicals. On the daily chart, gold has confirmed a death cross with the 50-day average below the 200. This usually signals a long-term bear trend, but the geopolitical chaos is making the charts look a bit wonky. The Relative Strength Index, or RSI, is sitting around 50.2, which is pretty neutral, not overbought or oversold. We've got major support sitting at the golden ratio of $4,543. On the 1 hour and 4 hour charts, we're seeing a bit of a recovery, with higher lows forming since April 6th. The Bollinger Bands on the daily are starting to tighten, which usually means a big explosive move is coming soon. If we can break and hold above the resistance at 4,745, the bulls are back in charge. But if we close below 4,600, expect a fast slide down to test that 4,500 floor. Watch the 10-year Treasury yield. If it stays above 4.3%, gold will struggle to make new highs. To recap, we saw oil crash 16% as ceasefire talks deflated the war premium in the energy market. Gold dipped early in the week but bounced back hard to test $4,800 by Wednesday. The ASX 200 outpaced the SP 500 with a massive 2.6% rally after the Easter break. AMD and Meta signed a $60 billion deal that proves the AI infrastructure boom is the real deal. Copper and silver are facing massive structural deficits because the world needs more metal for data centers than we can mine. The US dollar is facing de-dollarization pressure from the Petroyuan, but still managed a short squeeze against other currencies. And gold technicals are in a bit of a standoff, trapped between a death cross and strong physical buying. So, legends, what do you reckon comes next? Will the oil crash bring down gold, or is the AI boom going to send metals to the moon? Drop your predictions in the comments below, and let's see who's got the best crystal ball in the crew. Don't forget to smash that like button and subscribe if you want to stay ahead of the game with the Gold Jumper. Stay active, stay legendary. Catch ya!